High risks, high rewards. That's the quintessential narrative around startup investing, isn't it?
That's the common perception, Charlotte. But it brings to mind a question. Have we oversimplified it? Have we ignored the nuances of this dynamic arena in favor of a catchy phrase?
Right, Natalie. Is this phrase painting an accurate picture of the venture capital and angel investment landscape? Or is there more to it?
Perhaps it's time we drilled deeper. How has this concept evolved over the decades? And what does it signify in today's diverse investment playground, with investment options like crowdfunding, traditional equity and debt investing, and, not to mention, the prominence of specific industry startups?
And while we're on it, let's not forget the unique challenges of startups in niche sectors. For instance, nuclear technology startups.
Or food-based startups. Each carries its own set of risks.
But at the same time, these startups can be highly lucrative, right, Natalie? They can fundamentally disrupt industries and generate astronomical returns.
Absolutely. And it's these potential high returns that make this game of risk enticing for many investors.
So Natalie, tell me, how would you define startup investing?
Well, at its simplest, startup investing involves providing capital to emerging companies, with the expectation of significant future returns. This is quite different from traditional investments like buying shares of an established company or investing in mutual funds. Here, you are betting on the potential of a relatively new and unproven business.
So instead of investing in a proven business model, investors are essentially investing in an idea or a solution, one that could disrupt the market, right?
Exactly, and that's what makes it fascinating. You're part of the bedtime story this company is writing. You're not just buying into profitability, but a vision, an idea, a hunch. It's going all in on a creative concept and a passionate team.
And in return for taking on such significant risk, investors become not just spectators, but active contributors to the story. They obtain ownership stakes, and their capital helps these startups grow from their infancy stages into potentially profitable businesses, right?
Yes, Charlotte. And this ownership equity is a big deal. It can lead to substantial return on investment if the startup becomes successful, and that's why startup investing can be a very lucrative avenue. However, it's important to remember this is not a surefire path to riches and requires strategic planning, risk assessment, and in-depth understanding of the business.
Natalie, you previously mentioned that startup investing offers equity ownership. Could you expound on that advantage?
Absolutely, Charlotte. When you invest in a startup, you're purchasing a piece of equity in that company, essentially becoming a co-owner. This ownership can pay off in a big way if the company grows and becomes successful. Think of it like planting a seed and watching it grow into a tree. If the tree bears fruit, you get to share in the harvest.
That sounds like a highly rewarding aspect. But besides the potential financial gain, what other benefits does startup investing bring to the table?
Well, there's the growth potential. The financial returns can be tremendous if the company scales. There's the story of Uber's first investor who invested $20,000 in 2009, and by 2014, his investment was worth $40 million, or that's 2,000 times his initial investment.
Wow, those numbers are staggering. But it's not just about the money, is it?
No, it's not. One fascinating aspect is the ability to participate in disruptive innovation. It's about supporting ideas that could potentially change the world. You're not just betting on a company, but a vision that could reshape our societies.
An entirely rewarding experience on multiple levels, then, not just financially. It feels like you're contributing something significant and helping realize a dream.
Exactly. And remember, every successful company began as a startup. Facebook, Apple, Google. Imagine being an early investor in one of those giants. That's the potential of startup investing.
The risks, they seem threatening, don't they, Natalie?
There's no denying that, Charlotte. Investing requires courage. You're putting your money into a business that might succeed or even fail. It's unpredictable, that's for sure.
And this unpredictability, I imagine, can stem from various areas. Let's talk about business viability for starters.
Business viability is indeed a significant risk factor. Many startups fail because their business idea isn't marketable, or the market size is significantly smaller than projected. Or in cases where the product is innovative, the market might not be ready for it.
So it's not enough for the product to be innovative? The market, too, needs to be receptive.
Exactly. And then there's market unpredictability, largely influenced by factors outside the startup's control. Economic fluctuations, regulatory changes, or even a pandemic can wreak havoc.
Speaking of external conditions, how does one strategize or foresee such risks?
Well, thorough market research, trend analysis, staying updated with industry news can help investors anticipate and prepare better. But at times also, being flexible and adaptable is key to weathering these uncertainties.
So it's a mix of caution, research, and adaptability. I can see why this is not for the faint-hearted.
Indeed, it's a rocky but invigorating ride, Charlotte. The risks are real. But remember, no risk, no reward.
Natalie, let's now dig into various forms of startup investment.
Sure. The two most prominent forms are venture capital and angel investing, each with unique results and strategies.
I'm fairly familiar with venture capital. These are usually large firms that pool investors' money, yes?
Exactly. They pool capital and invest in startups that have potential for high growth. Typically, they come into play when the startup is a bit more mature and needs a larger pool of funds to scale further.
I've heard they often require a significant equity stake and usually seek representation on the board.
Yes, that's a major part of it. They become influential in guiding the startup, which could be beneficial given the expertise and networks they bring.
On the flip side, I'd imagine too much influence might edge out the original vision of the startup founders. What about angel investing? I'm not as familiar with that.
Angel investors are typically wealthy individuals who invest their own money into startups, usually in their early stages. They might not contribute as much capital as VCs, but they also generally don't exert as much control.
So, less control, more flexibility for the startup's vision?
Precisely. They often play an advisory role and focus more on helping the startup to succeed while maintaining its original concept.
Interesting contrast. So, bottom line for our budding investors is?
It really depends on individual investors' situation. If they have extensive industry experience, substantial capital, and are willing to take a more active role, venture capitalism might be more appealing. However, for those with less capital, looking for lower risk involvement and creating a mutually beneficial relationship with the startup, angel investing could be a better option.
Crowdfunding. It's yet another trend in this dynamic world of startup investing. How does it differentiate from traditional investing, like venture capitalism and angel investing?
Well, crowdfunding is a unique phenomenon. It essentially democratizes the startup investment landscape, allowing interested everyday people, not just seasoned investors, to back a startup.
So, it sounds like it could be a viable route for someone with less capital, similar to angel investing?
Absolutely. But it's different in several ways. With crowdfunding, individuals can invest relatively small amounts of money into a project or venture they believe in. If enough people invest, the startup should reach its funding goal.
Sounds like a fantastic way to get the public involved and potentially gain a wide base of investors. Though I'd imagine this also makes for a diversified and sprawling network to manage. Could there be drawbacks with this approach?
Interestingly, yes. Managing a crowdfunded project can be both a benefit and a challenge. The diversification diminishes risk, but the process of continuously updating a large number of investors on the startup's progress can be demanding.
I see. There is definitely a balance between access to capital and management. I've also heard some myths about crowdfunding. Are there common misconceptions?
One big myth is that crowdfunding is an easy way to get money. While it can be a powerful tool, it requires a great deal of work in marketing the campaign to potential investors, creating rewards or incentives for contributions, and ensuring the project meets its funding goals. Another myth is that anyone can crowdsource any idea, but the reality is investors are more likely to back projects that they can envision having a high return or that resonates with them on an emotional level.
Interesting. So it's crucially about resonance, vision, and the promise of returns. Thanks. That really clarifies the picture of crowdfunding and startup investing. Earlier, we delved into crowdfunding as a method of startup investing. Now, let's examine two other significant concepts: equity and debt investing. I'm familiar with these as they're common in the finance world, but in the context of startup investment, they can have different implications, right, Natalie?
Yes, That's absolutely correct. With equity investing, investors acquire ownership in a startup in exchange for their investment. This usually happens through purchasing shares. The major allure here is the potential to participate in the startup's success as it grows, but the flip side is the risk. If the startup fails, the investment could be lost.
Right. And I think it's fair to emphasize that in the world of startup investing, the risk can often be substantially high due to the unpredictable nature of startups. Their success or failure hinges on a number of factors: product viability, market trends, management competence, and so on. But if they hit it big, the payoff can be massive.
True, the gains can be immense. Now let's talk about debt investing. This is when investors lend money to a startup at a fixed interest rate. The return is comprised of interest payments and the eventual return of the loan's principal amount. While the upside is usually smaller than equity investing, the risk is also substantially lower. Even if the startup fails, debt investors often have a priority claim on assets over equity holders.
So, an investor might choose equity investing if they're looking for high growth potential and are comfortable with greater risk, while debt investing could be a safer and more predictable choice. However, much like everything else in investing, it's probably wise to balance the two and not put all eggs into one basket, right?
Exactly. Diversification is key, and smart investors often mix equity and debt investments depending on their risk tolerance, goals, and the specific opportunities available.
Given our discussion on the risks and potential rewards of startup investing, it's apparent that a strategic asset allocation is crucial. Might this strategy differ when it involves startups?
It does, Charlotte. In fact, asset allocation with startups is quite an art. It's about balancing the potential extreme high returns that startups can offer with the substantial risks that come along with it.
So much like a seesaw, isn't it? How does one manage such a balancing act?
The key lies in diversification. Investors often spread their investments across a number of startups, reducing the impact if one startup fails, while also increasing the chances of investing in a highly successful one. They invest in different industries or companies at different stages of growth.
It reminds me of something I heard once. Diversification is the spice of an investment life. A single investment going bust doesn't sink the entire ship, and a single investment striking gold can make a significant positive difference. Managing these investments must be quite complex, though, right?
Indeed, it is. Asset allocation in startup investing demands a strategic, meticulous approach. It requires thorough knowledge of varying industries, an eye for evaluating startup potential, understanding market dynamics, and frankly, a bit of intuition as well. Simply put, diversification helps investors balance high-risk, high-reward scenarios across their investment portfolio.
Do startups really pay off? This is a question we often come across.
But answering that requires understanding of key factors. For starters, returns from startups are highly variable.
Yes, the truth is, most startups don't see the light of day. It's a high-risk, high-reward landscape.
To be precise, for every 10 startups in investor funds, 5 to 7 amount to nothing. 2 to 3 might return the initial investment, and if they're lucky, one could emerge as the so-called unicorn, providing massive returns.
So is this variability a reason for fear, or does it hold potential? Natalie, what has been your observation?
It's both, Charlotte. While variability implies higher risks, it also means there's a chance for equally high returns. It's a matter of perspective. Opportunistic investors view this as a lucrative setup, while conservative investors might find the risk unpalatable.
And how significant is the role of a startup's total market capitalization in this?
Very significant, Charlotte. This total market capitalization provides a good measure of what a startup is potentially worth, indicating the possible return on investment.
Natalie, I suppose it's fair to say that in the world of startup investing, patience is indeed a virtue.
Indeed, one can't expect immediate gratification from startup investing. It's a long game, typically taking 7 to 10 years for a startup to mature and provide returns.
A bird cannot fly with one wing only. This Chinese proverb perfectly summarizes the essence of our next segment. Don't you agree, Natalie?
Yes, Charlotte. It's all about balance. The balance between knowing, understanding, and most importantly, experiencing.
Precisely, Natalie. Going by that, let's take this opportunity to bring theory and practice together by opening up some case studies of successful startup investments. Would you mind if I start with a story very close to my field?
Not at all, Charlotte.
Well then, let's talk about the story of a startup named TerraPower. TerraPower is a nuclear innovation firm that came alive in 2008. With a mission to lead in global energy decarbonization, it embarked into the world of traveling wave reactor technology.
Interesting. What's the reason for their success, though, Charlotte?
The most significant factor was their bold, disruptive technology, Natalie. However, what drove their success in the investment landscape was their ability to capture the eyes of significant venture capitalists, the largest being Bill Gates himself.
So, attracting high-profile investors gives a startup its much-needed wings, a valuable lesson for all potential entrepreneurs.
That's one way to look at it, Natalie. Would you like to share a success story from your field?
Absolutely, Charlotte. Let's consider a startup called Blue Apron. They're a meal kit delivery startup that had a breakthrough due to their innovative offering. Serving about 3 million meals per month, they're the perfect example of how startups can disrupt traditional industries.
That's the beauty of startups, isn't it? Utilizing innovation to disrupt and take lead. What has been the key to Blue Apron's success?
Blue Apron's success has been a combination of innovative idea, capturing a niche market, and gaining the trust of venture capitalists. The company secured a funding of $199 million, allowing it to thrive and expand its user base.
So the right idea matched with the right investor can steer a startup's journey to the stars. Combining both these stories, we can see that successful startups have the power to make distinct, disruptive contributions in industries, and the correct venture capitalist can play a big role in such success. But it all starts with the right idea and the execution of that idea. We've discussed the journey startups take from inception, attracting investors, all the way to growing and achieving their purpose. But once the startup has reached its peak or potential, then what? Natalie?
That's when investors think about exit strategies, right?
Exactly, Natalie. Exit strategies are a part of an investor's investment plan. They answer the question, how and when can I get my money back? Now, there are many strategies for exit, but the most common are probably selling the company or going public.
Selling sounds straightforward, but going public, that's an IPO, isn't it?
Yes, IPO, or initial public offering. It's a process where a private company offers its shares to the public. This process turns the company from a private to a publicly traded one. The company can raise funds selling these shares, and the investors finally can get their investment back through selling their shares on this new public market.
Whoa, sounds very interesting. But when and how do investors typically choose between selling and going public?
The choice of exit strategy can depend on many factors. The market situation, investors' investment goals, the startup's future prospects and growth, and even the startup's industry sector. For example, in my field, the nuclear technology sector, public markets and majority buyers may not exist or may be less lucrative. So in such cases, strategic acquisition might be favored over an IPO.
And strategic acquisition is when a bigger company buys out the startup?
Correct, Natalie. And it's not just about getting your return. The timing of an exit is crucial too. The investor needs to decide when the startup has reached its maximum potential for returns before exit.
I see. A lot of factors come into play. So I'm starting to realize that investing in startups isn't just about picking the right startup, but also about making smart decisions throughout the entirety of the investment lifecycle.
The startup investing territory is shrouded with myths, isn't it, Natalie?
It surely is, Charlotte. Probably the biggest myth is the whole get-rich-quick idea. Most people think all they need to do is inject money into this next big thing startup and voila, they're millionaires overnight.
Right. The majority of startup investments don't pay off, especially not instantly. In fact, many startups fail or just barely break even. The get-rich-quick myth doesn't take into account that patience and due diligence are key components of startup investing.
Correct. It's essential for potential investors to comprehend that patience is a virtue in the startup investing scene.
Another misconception is that you need oodles of cash to start. But truthfully, while investing in startups can require significant capital, there are options like crowdfunding and syndicates, where you can start with smaller amounts.
That's right. And platforms for crowdfunding have indeed made it possible for anyone to dip their toes into startup investing. Another myth is the belief that only Silicon Valley tech startups make good investments. Thus, only targeting tech companies limits an investor's opportunities. Remember, startups span across a variety of industry sectors, like my field, the culinary industry. There's so much untapped potential there.
Indeed, Natalie. Startups are not limited to Silicon Valley or technology. Significant innovations can come from any industry, and savvy investors must be open to exploring the unfamiliar. Our listeners have raised some terrific questions, Natalie. Shall we dive into some of them?
Definitely. Let's start with this one we received from Alex. How crucial is the role of due diligence in startup investing? Charlotte, would you like to take this one?
Absolutely, Natalie. Due diligence is incredibly important in startup investing. It involves thoroughly vetting and understanding the business one is considering investing in. Without it, one is essentially investing blind. Understanding their business model, market size, competitors, revenue trajectory, and management team are some of the key aspects involved in due diligence.
Great explanation. Our next question is from Maya, who asks, as an aspiring investor with limited capital, how can I enter the startup investing landscape? This one's for me. Maya, don't worry if you have limited capital. Startup investing isn't limited to the wealthy. Crowdfunding platforms are a great starting point. These platforms allow you to invest smaller sums into startups you are curious about. Always remember, research the startup thoroughly before investing. Even a small sum should be invested prudently.
Very well said, Natalie. Now here's an interesting one. Would you recommend investing in nuclear technology startups, given the potentially super high risk? Well, I firmly believe that nuclear technology startups are instrumental for a sustainable future. Sure, they pose some substantial risks, yet they can be huge game changers. For me, it's a classic case of high-risk, high-reward scenario. If you're comfortable with the risks and passionate about advancing sustainable efforts, investing in these startups could be a terrific opportunity.
That was very insightful, Charlotte. I see a question related to my field. What potential do you see in culinary-based startups? Well, culinary startups offer a fascinating and creative playfield for investors. With evolving food trends, people are always looking out for the next big thing in the food scene. So investing in culinary startups can lead you to unique opportunities. But bear in mind, like any other startup industry, it requires comprehensive understanding of the market and the target audience's preferences.
With all that we've covered, it's time to discuss some practical tips and resources for beginner investors. Natalie, mind if I kick things off?
Go for it, Charlotte.
First, I'd stress on the importance of adequate due diligence. Remember, investing in a startup means investing in its team and idea. Make certain you understand the business model, the competitive landscape, and the market size. Misunderstanding any of these elements can lead to needless risks.
Definitely. And building on that, it's also important to diversify your investments. This isn't the stock market. Startups can and do fail. Spreading your investments lessens the sting of potential losses. Charlotte, do you have any preferred resources for learning more about the nitty-gritty of startup investing?
I surely do. Venture Deals by Brad Feld and Jason Mendelson is an excellent read. It provides a detailed look at how venture capital deals work. For individuals interested in crowdfunding, I'd recommend Equity Crowdfunding, The Complete Guide for Startups and Growing Companies by Nathan Rose.
Those sound like great resources. I've also found Angel, How to Invest in Technology Startups by Jason Calacanis to be a very insightful read. It helps shed light on the mechanics of angel investing. Now, what about you, Charlotte? Any investing tips specific to your field of interest?
Absolutely. For those eyeing the nuclear technology startups, it's pivotal to have a firm grasp of the technology and regulatory landscape. While potential rewards are high, the same applies to risks. Remember, in-depth comprehension is crucial. Lastly, patience is key. Startup investing is a long-term game. Do not expect overnight success.
And that wraps up our tips and recommended resources for all you beginner investors out there. Just a handful of pointers to help you navigate the exciting world of startup investing. So, as we near the end of this deep dive, it's worth discussing where we currently stand in terms of startup investing trends. Charlotte, do you have a particular sector within the startup landscape that you feel is trending at the moment?
Nuclear technology startups are certainly gaining traction, Natalie. With increased focus on sustainability and clean energy, there's potential for such startups to disrupt the energy industry. However, technological complexity and regulatory barriers can make it a challenging field for investors. There's a lot to consider before taking the plunge.
Absolutely. And reflecting on my field, I feel we're also observing a surge in food tech startups. Innovative solutions are required to make the food industry more sustainable and efficient, driving investor interest in this sector.
Indeed. Moving forward, the aftermath of COVID-19 is bound to play a huge role in shaping the future trajectory of startup investing. Increased digitalization and remote working could stimulate the growth of tech startups, while leaving traditional businesses struggling.
I agree, particularly in the food industry, where delivery services and cloud kitchens have been thriving during the pandemic. However, alongside this digital shift, there's also a significant risk element. Startups may face an uphill battle in securing funding as investors become more cautious in a potential recession.
While we can see some directional trends, it's crucial to keep in mind that startup investing is inherently unpredictable. The landscape is dynamic and shaped by not only economic conditions, but also technological advancements and societal changes.
That's a good point, Charlotte. The uncertainty of it all can be unnerving, but that's the beauty of startup investing. It's like being on the forefront of innovation, witnessing firsthand how an idea morphs into something groundbreaking.